Just waiting for Greg to turn on his microphone. Just hold on one second.
Morning, everybody. I appreciate you joining us here. I enjoy hitting lead off, and I get to lead off a great day here at Cyber Trading University. I get to talk about a topic that I really enjoy, and I'm guessing a lot of you are unaware or have very limited knowledge about trading FX options. We hear a lot about trading options. We hear a lot about trading FX, but the combination of the two provides a real unique opportunity in the market. So we're going to start the presentation. We'll leave that disclaimer up there. As always, trading does involve risk. We don't want you running out, particularly at any of the things we might say this class, and trading on those without fully evaluating the risk of those trades. About Cyber Trading University, Fausto touched on it a little bit earlier. Educational trading institution since 1995. Established itself as a leader by first working directly with the SOES trading firms to teach day trading. CTU was one of the first to establish itself as a quality stock market trading. Each instructor has a minimum of 6 years of actual trading experience. Over the last 14 years, we've taught thousands of students to be successful and profitable traders. CTU headquartered in New York. About me, Fausto touched on this. I'll just reiterate, got my master's degree in Sydney, Australia, down at Macquarie University after a BS at St. Joe's in Philly. Was a crude oil trader, head options trader. We've been through this, you understand. I've been around the block once or twice, so let's get to the good stuff. Now, we're going to talk about FX options basics, and what I'm going to do is, I know some of you have never traded options. Some of you have been options trader. I'm going to briefly give everybody up to a certain level. Options are contractual agreements to buy or sell either a stock or underlying currency at a specific price over a specific given period of time. They're a derivative instrument, therefore their value is derived, hence the name, from an underlying security. People like to talk about the danger of options. It was Warren Buffett who famously referred to them as derivatives as, weapons of financial mass destruction. That really depends on how you use them, just like anything. The analogy I like to use with people is, water is great if you're thirsty, but if you're at the bottom of a pool, maybe not so good to have a lot around. So again, we're going to talk about how to safely use options as a way to build your portfolio. They were created to hedge risk. Since then, they've gone beyond that and become a tool that can be used to take risk and speculate. Long options, we're talking about call options. Again, I'm not going to touch this for a moment, but we give the owner the right but not the obligation. And that's very key to the whole system of options trading. As the owner, you have the right but not the obligation to buy the underlying security at a fixed price over a given period of time. They call that calling the underlying away from the owner. The key there, again, you have rights but not obligations because you've paid for the option. You've got a put option. The owner has the right, again, but not the obligation, to sell an underlying security at a fixed price over a given period of time. You can put that underlying back to the owner. Here's a quick graph of what a long call looks like profit-wise. This is a stock graph, same for everyone. The area that you're looking at in here is the difference, the amount that you paid for the underlying, for the option. Once we've reached this point, as the graph goes up, the option would appreciate in value and would go into profit up at this end. Again, I'm just trying to give everybody a baseline on options real quickly. We'll get to the FX stuff in a second. Long put looks like the same, but it's a little bit different. You make money on the back side of the trade. You make money when the underlying crosses this point and the price of the stock, in this case it was a stock, goes down. So very simple overview. We're clearly going to spend a lot more time in the classes that I'm going to be teaching over the next couple of days and in the future on options. This is just a baseline as we move into FX. When you're short puts, this is where things can get a little dicey. You gives the seller the obligation to sell an underlying security at a fixed price over a fixed period of time. I want to just point out, it's the obligation that turns the can turn an option, a short option, into a dangerous position, because regardless of where the underlying security goes, you're required to sell it. You've taken a premium, you've taken the premium from the buyer, and therefore you've given up your rights and you've turned it into an obligation. Seller of a call option, a put option has that same but reversed obligation to buy an underlying security regardless of the fixed price. Real quick example, we'll use the calls. If you have a stock that's trading at $25 and you sell a 30 strike call, as long as that stock's below 30, that call intrinsically has no value. But if that stock went to $100 and you did nothing else to hedge your position, you'd be obligated to sell the person who bought that call, that 30 call, the underlying stock at $30, and then you'd have to go to the market to reverse and hedge that trade. So you can put yourself at great risk when using simply short options all by themselves. They really, normally for retail investors, recommend steering very, very clear of just naked short option positions. This is what a short call looks like. Your loss happens as you cross the break-even point and the price of the stock, in this case, increases. Put just the opposite. Your risk is, as with the stock and the price dropping significantly, you're looking at a short position and trouble, really, is the simplest way to put it. Quick box to go over. Long means owned, short means sold, calls and puts. If you have the right to buy or the right to sell, you own the options. If you're obligated to sell or obligated to buy, you are short the options. So a long call will have the right, in our case, to buy a currency pair. A short call will have the obligation to sell a currency pair. And let's move into those currency options. As I said, most of you are probably not even familiar with the options that are traded listed. There are two NASDAQ, Forex trades options, and they also, the ISE, the International Securities Exchange, has listed currency options. And we're going to give you some details because they're really great trading tools. Not a lot of people are aware of the value that they bring, and I think it's something that can help your trading for a number of reasons. They take the advantages of options, the risk management tools of options, the profit possibility, and the leverage, and turn that into an underlying using the movement of foreign currencies. So if we look at the world currency pairs, also the NASDAQ world currency options, you got the British pound versus the US dollar, the euro versus the US dollar, Canadian dollar versus the US, Australian versus the US, Swiss franc versus the US, and the yen versus the US. The first thing you're going to notice about the pairs, and one of the big differences between the world currency options at the NASDAQ and the ISE options are, these are all denominated with the dollar being the counter currency. What do I mean by that? You guys who are currency traders understand that. But the first in the pair is the base, and then the second is the counter. So all of these are denominated in US dollars, with US dollars being the counter currency. Now we know that if you're an active FX trader, you'll know that something like the yen is a different normal pairing, whereas the pound dollar is more of a normal traded. Now you can trade either side of these, but what does it mean to say I'm trading the pound versus the dollar or the yen versus the dollar? You are effectively taking a position that, let's say you're long the pound versus the US dollar, that in relationship to each other, the pound will increase in value based on the US dollar. So it's a very simple relationship. People think about currency pairs and get kind of lost and confused about base and counter currency. Well, what I use a pretty simple analogy. When you go buy a gallon of milk, you have the same thing. It's milk versus dollars. And then what is that? It's, I don't know, my wife will shoot me if I say something too low, but probably say $3.85 for a gallon of milk. So in our situation of milk, it's milk versus dollars, and what's that price? $3.85. In this case, it's the British pound versus the US dollars. And all of the currency pairs on the NASDAQ world currency options are based on the dollar being the counter currency. And I'm pointing that out for a couple of reasons. You'll see the difference when we get to the ISE and their pairings. The British pound is at 10,000. It's 10,000 British pound, 10,000 euros, 10,000 Canadian, 10,000 Australian, 10,000 Swiss franc, and 1,000,000 yen. All these numbers very familiar to anyone who is an FX trader. The same sort of rounded lots, smaller rounded lots you're used to trading. I like to call these a right-sized contract for retail investors, and the reason is the contract and point value, very similar. It's 100 basis points equals $100. That's nice, easy, simple math for all of us to work on. It's a nice, easy contingency. So one option contract priced at $2.50 cost the investor $250. Very easy to think about that when trying to plan your trade. Most importantly, plan your exit for profit or your stop loss. How much am I willing to lose? I can do that on a 100 basis point contract and set up my trade accordingly. Therefore, one options contract price movement of 1 cent equals $1 to the investor. So if our $2.50 option went to $2.60, went up 10 cents, your contract would make $10. Expiration. We've got a European expiration. I'm sure any of you are options traders understand what that means, but European exercise means there is no early exercise. The options expire on the Saturday following the third Friday of the expiration cycle. Let's take that back a second, because if you're an equity options trader, you're used to an American exercise, which can change the value of the underlying security, particularly an equity if there's for example, a dividend involved. There's times when you may want or need to exercise early. These options do not exercise early. They only exercise on expiration. Now, that doesn't mean you have to hold the position until expiration. You're more than welcome to take a winner and sell it back in the market, zero out your position, and move forward. So let's be clear. It doesn't mean that once you're in an options trade with the world currency options, you have to hold it till the Saturday following the third Friday of the month and hold your ticket and see whether you won. Clearly not the case. But it does limit some of the manipulation and movement in the market that you can see with an American exercise option, particularly those that have simply a dividend play, which is a common options trading strategy. People will do dividend plays for deep in the money calls. That's a topic for a different day. But you're looking at the third Friday of every month. Settlement's based because the currency markets, unlike the equity markets, only close and open once. We open at 7 or 8 o'clock East Coast time on Sunday nights and don't close till 4 in the afternoon on Friday. Stocks close because there's a closing price. Well, there really is no technical closing price, but what they use is settlement is based on the 12 noon Eastern buying rate as determined by the New York Fed. For those of you that are worried about what if there's a power outage, don't worry, I've been through it. There's a long, long list of contingencies to get a price to expire at expiration. And everything is settled in U.S. dollars. What does this mean to you? It means that if you have a current brokerage account that trades options, you can do that. You can trade them through any of the myriad of listed brokers that we have. It's the symbols that we showed you, XBE. I can even flip up and show you, maybe I will in a minute, what the options look like. But yes, you should be able to trade these with any broker who's listed to trade options. When do they trade? Now, this is the difference. The currencies trade 24 hours a day, 7 days a week. The trading hours for the world currency options, Eastern Standard Time, 9:30 to 4, what we would call regular U.S. trading hours. Hopefully someday a lot of you have to worry about the contract limits. I've never had this issue when trading currency options, but 200,000 contracts on the same side of the market. All trades are issued and guaranteed by the OCC. What's that mean to you? A lot of the people who trade and have traded currency over the counter in the spot market and traded currency options over the counter are not necessarily governed by the rules of the OCC. Why is that important? Well, the OCC guarantees that and eliminates the credit risk of your counterparty. So if I did a trade with Fausto and I would be guaranteed through the OCC to Fausto, and Fausto would be guaranteed to me, just like you have on the U.S. regular options market. We guaranteed a counterparty so that if your counterparty was unable to fulfill the obligations of that contract, the OCC stands in between the two of you and guarantees that that would happen. You can understand when you think about it, if we all did trades without knowing who we were doing business with, and we bought options and sold options and bought options and sold options and then built a position, and then a third of the people that we did business with did not honor their contracts, we clearly could be in have a very big problem with our position. It would grind trading to a halt. But the OCC steps in as the guarantor on both sides of the trade to allow a free trading and liquid market. The world currency futures, there is a hedge for the world currency options. Again, I'll be very honest with you. They don't trade a lot, and there are probably better ways, which we could talk about at another time, to hedge these trades, but they are based on the world currency futures that trade on the NASDAQ, same contract sizes. And they also trade, they are a way to hedge, and you also can trade them standalone. A lot of people, you would use them more than that than for the options. Again, their trading hours are a little bit different. Similar operation, though. They open a little bit earlier, close a little bit later, which is normal for an underlying. Expiration is the same. Cash settlement, all guaranteed by the OCC. If you're interested in going looking up the futures, and again, anybody who wants a copy of this PowerPoint, just send me an email. I'll give you my email at the end. Be happy to send it to you. But these are the symbols for the world currency futures that underlie. The ISE, the International Securities Exchange, also trades currency options. And if you look at their currency options, I pulled this list off of theirs. Here's their symbols here. We got Australian. But if you look at it, there's something on this side of the ledger that's the exact opposite of the world currency options. If you take a minute and look at it, you'll realize that the US dollar on these is the base. So the dollar is the base currency. In this case, I'm pointing to Australian, is the counter. Now, they do offer the opposite, because there are a couple of trading pairs that are normally traded. For example, it's usually the pound dollar, the euro dollar, the Aussie dollar, and the New Zealand dollar versus the US dollar are more normally traded. They're the normal pair that's traded. So you can trade either side of this. For example, if you look at the British pound, you could put on a dollar pound or a pound dollar trade. What's that mean to you? Well, there's a couple of things that it allows you to do. It allows you to take positions versus the US dollar or versus the pound in this example, buying options. And let's say you always want to buy, you're a call buyer for whatever reason. It allows you to profit. You could either, if you thought that this pair, the dollar was going to increase. Well, if the dollar is going to increase versus the pound in this one, then this one has to go down. It's an inverse relationship. So if you bought a call here and you bought a put here, you'd have exactly the same risk position on if you took the same strike. But it allows you the ability to maybe more accurately match your hedge if you wanted to use your ISE options or your world currency options to hedge an underlying spot position. We're getting a little bit ahead of ourselves. It's something for another day, but there are ways to use options as a trading tool in conjunction with FX spot trading. So that's the annotation is a little bit different than the world currency options, but it's there for a reason. And think about it: the world currency options were there first. The ISE came into the market, and from a competitive standpoint, had to make themselves a little bit different. I happen to know the guys over at the ISE. I know some of the people at the Lex, but I know the guy in charge of marketing, a really nice guy, and they do a nice job at the ISE. I'm not telling you to trade one versus the other, but they came into the market second and have been very aggressive to try to gain their share of the market. This is from their website. The ISE FX options provide investors with additional choices and flexibility to hedge their currency risk exposure. They're cash-settled U.S. dollars, so similar to the world currency options. European exercise the same and can be traded from your brokerage account. You could, someone just asked, I'm going to take a moment. Kumar asked, could you use these options to hedge Forex? I'm guessing you mean spot trades. You could, but there is a little bit of a warning with that. You do have to worry about, does your broker look at it as a hedge? And does your brokerage account allow you to trade options and trade spot? They may or may not see that as a hedge, and I can't tell you which brokerages will and which brokerages won't. From your point of view, from your account, you could end up with a margin situation, and that's the key. If they allow you to margin FX spot versus a hedging position in the underlying options, then you're in a much better position because you can do those trades without as much margin implication. You may end up with a broker, and I can't tell you which doer, it's for you to find out, but you may find out that your broker margins each of those separately, although they're offsetting trades. You'd have to come up with more margin to be able to trade. But ultimately, if you've got a position where you can make money if it goes up and you've got a position where you're hedged if it goes down, you should be able, once all those trades settle out, to have put together a hedged trade. So it's something we can talk about another day when we get more into it. Contract specs, I'm not going to bore you with this, but underlying represents the same U.S. dollars, the base, and the counter currencies, our other currency. Still the same $100 modifier, 10-cent minimum strikes. They do normally have 50-cent minimums. Same 1-cent minimum, same European, same Friday expiration, same 12 o'clock price. So they all settle out at the same price. So just quickly, FX trading sized for the retail investor. You've seen that you can, most of these options, and I'm going to flip it up and show you the options real quickly. You can see that these options trade, anywhere from under $1 to $1 or $2. Multiply that by 100, you're looking at 100, 200, maybe $300 to own an option, which can have a really significant, underlying movement. I'm going to flip you out of here after we go through these caps. You can trade in a volatile market with the advantage of options. For those of you who are options traders, you understand the inherent safety in owning options in a volatile market. Again, as an owner of an option, you have the right but not the obligation. You don't have to do anything. You also know that when you pay $1.25 for your one lot and it costs you $125, no matter what happens to your underlying, whether it's futures, FX, equities, commodities, it doesn't matter. You can only risk that $125. So there isn't, in a volatile market, there's a way to get into the market and maybe have the protection of using options. The options are traded during the U.S. market. Now, again, I saw a lot of you checking in from around the world. I'm sure if you're trading, you're used to the inconvenience for you of being up or staying up late or getting up early in the morning to trade the U.S. market. But the options market is open. And there's one thing that I haven't mentioned, but the inherent fact that the options market closes for the FX can lead to gaps when trading, which if you're an options trader, you hear the word gaps, it's one of your favorite words because that's how you can make money with options. So sometimes you can use the fact that the underlying trades all the time, but the U.S. market is closed for the options to your advantage. Again, very much similar to a U.S. index option. Equity option strategies and math work for the world currency options and the ISE options. So the things that you've learned, Fausto talked about it before, 90% of the things you learn can be passed. That discipline, that strategy, that work ethic works in the FX currency options just like it would with equity options or currencies or equities. So it's the same idea. I am going to give you one quick, I'm going to share my screen real quick. I just want to show you very quickly, share my desktop. Hopefully it will share. There it is. Okay, so this is I brought up an an FX option trading screen. For those of you who are options traders, these numbers are like music to your eyes. You enjoy looking at it. For those of you that are new to options, this is probably a little overwhelming. All I want to point out is we're looking at the PHLX British Pound XDB option, currently trading at 166.38, we'll call it. The underlying is trading at $1.66.38. So this is 100 times to get to this figure. What I do want to point out is, for example, you've got strikes running here from the, I'm looking at the Mays, which expire, if you follow my mouse, in 23 days. You've got the 166s, the 167s, and for example, the 167s right now, they're offered at 89 cents. What's that mean to you? That you need the underlying to go to 167.89, which is a movement about $1.50 on the future, or to get to break even. And the one thing I do want to point out, it's the only thing I want to show here, and then we're going to move on with the presentation. For those of you that are options traders, you always look at things like implied volatility. And look at the implied volatility of these options. We're looking at a 6.5% implied volatility. What's that mean? That means that the underlying, in this case, the future, should move about 6% over the life of annually, which is divided by 15, about 4 to 6 cents a day, I think, divided by 15. So it's a very, very, very low implied volatility. When options get very expensive, the biggest reason is the implied volatility is very high. So this is a very inexpensive way to take a longer, normally longer-term view of an option in the FX market. For example, if you really thought that the pound dollar was going to move significantly, and you wanted to take a long-term view out to June, I mean, you could look at options where the strike price is 170, and you'd pay about probably about $1 or so for them. Very inexpensive options to get you where you want to go. I am going to go back to stop sharing, and then we will bring this up. So again, just a quick look at what those options can do. Now we're going to talk about how would you use them. I just touched on it a bit, but you could use these world currency futures for a spot replacement. And again, whether it's world currency options or the ISE options, depending on the underlying pair and the direction that you want to go. You could purchase an in-the-money call or put to initiate a long or short currency position versus the US dollar. In this example, we are using the world currency. So instead of saying, I think in the longer term, the FX market is going to go up for the pound dollar, and I want to buy spot currency, I'd rather buy an option, say it's a call or a put, depending on the direction, and find a way to capitalize on the directional movement where I'm correct, but protect myself with the advantage of options. You've got a limited risk because, as we said, you only can lose what you put in to the options trade when you buy an option. We're always going to be talking about buying options here. So if you buy an option and it's $1 and you bought 1, your risk is $100. If you bought 10, your risk is $1,000. And until expiration, all you could lose is that $1,000. You can spread your time horizon out. If you're someone who likes to chart, I have a friend over in India who is a very long-term trader. I've still been able to get him to convince him they should use options. But the ability, if you have someone you're a chartist who likes to look at a very long-term view of a currency pair, you can stretch your time horizon with the built-in risk management of say you thought it was going to go up a call, you thought the currency pair was going to go down a put, looking at the pricing in those options being very inexpensive due to the implied volatility being so low. And again, you can also help you minimize the short-term market swings. How many times have we gotten into a trade, whether it's a stock or a currency pair, and you've got your stop, and the trading gods know you've just put on a long position in, the dollar-pound, the pound-dollar, pardon me, and dollar-pound, which either of them. And you, as soon as you put it in, the underlying trade's against you, shakes you out, and then 5 minutes later, it seems like it goes exactly the way you thought. Well, if you're a disciplined trader, what you would have done is set your stop, been taken out, and then reevaluate it. It's a lot tougher to jump back into a trade and maybe not the right thing to do once you've got taken out. So this allows you the ability to ride some of those short-term swings, particularly when you have a bias to the upside or downside with a longer-term view. Here's just a quick example. We were looking at that. This is an XDE, which is the euro US dollar. And the one that I've highlighted there, difficult to see, but it's the July, this is an example from before, July 153 calls. They were trading at $3.40 $3.55 with the underlying at 154.93. So they were in the money by about $2. So there's about $2 in intrinsic value, about $1.50 of extrinsic value. We purchased 10 of those for $35.55. Those. Then you'll see that the underlying went up to 157.91. So now those Julys are now in the money. And this is what we're talking about, being able to be in a trade, be right, and roll with it. You now can go buy the August 156s, so you're trading farther out. You're buying time as an options trader, which is a great thing. And you still have an in-the-money option. That would trade at 375. And so how would you have capitalized on this move from about 153 up to almost 158? If you look at it, we purchased the XDEs, the 153 calls, for $3.55, so they cost us $35.50. It went our way, so now we've got a winning trade. Now, one of the things you could do with this winning trade, if we go backwards, if it goes our way, we could just sell it out and take a profit, and that's always a viable alternative. But in this case, we took a longer-term view. We thought that the XDE was going to continue to move our way, and we can roll this. Now, this would be kind of we're really rolling up and out. You're technically taking and legging out to a vertical, to a calendar spread, because what we're doing is we're going to sell the 10 July XDE 153s that we own, and we're doing this as a spread, and we're going to purchase 10 of the XDE August 156s. So what have we done? We now have a trade where we've taken a 153 call in July. We've been right about it, decided we wanted to stay into the trade, and we wanted to have a longer-term view. So now we do a trade where we sell out the XDE 153 calls in July and simultaneously purchase the XDE August 156s. And if we go backwards, right now the 156s are trading at $3.75. So that's important, because when you look at this, we take a credit for the July. Let me put a pen here. So these were our Julys. We got a credit because we sold them out at $5.60, these 10 that we originally bought. We paid $36.50 to buy these 10 XDEs. So we now have a credit of $1,950. So we now own the XDE August 156 calls for $1.60, or about $1,600. And how do we get that? This trade gave us a $1,950 credit. We originally put the trade on for $35.50. So our bottom line is, we're in this trade. We now have $1,600 at risk. If the thing reverses and goes and we never do another trade, we could lose $1,600. Now, we were originally on the hook for $35.50, so we've cut our risk in half, and we pointed it out. $1,600 is what we've paid for these options. And if we look at, I'm going to go backwards. Oh, they're going to stay on. They're worth about $3.60. So let's just call it $2 for fun. We're $2 in the money on this trade, and we're still in it. And that's one of the unique things about options, is you can be right, take profit, and stay in the trade. We're still long. We're still could make money if this continues to move, and we've got until August to get this trade done. So let me move this forward. Someone's looking for the options chain. They don't see July. Sometimes, Bob, they're not necessarily traded every single consecutive month. It's usually the front 2 months and then on a quarterly cycle. So July should show up soon. The advantages of doing this, we've talked about it. Limited risk. You can stretch your time horizon. You can put on trades. If you're someone that doesn't have the ability to trade, sitting in front of your computer screen all day, every day, but you have an opinion in the market and you have maybe you use technical analysis or other indicators that give you a better look at a longer-term view. The options can give you a better way to execute those, particularly if you're not someone who can watch all day long because of the limited risk. We've said it before. Those short-term swings can be minimized. You can ride them out because you know your risk and you get into the trade. And as we just showed you, you can lock in profits while still maintaining the position size. Now, you can lock in profits and exit the trade, always a possibility, but this allows you to continue in a trade while still taking money off the table, which is a gigantic advantage. I'm sure a lot of people would like to be able to take, a stock position, take some of it off, and still have it on. That's one of the advantages of options. I'm going to talk to you about one more advantage of using FX currency options. You can do a cross-rate trade. And what is that? It's a currency pair that does not include the U.S. dollar. So here's examples of actively traded cross pairs: the euro pound, the euro yen, the pound Swissy, and the Aussie yen. And none of those, if you looked at all the listings, traded on the were listed as options. So what you can do is create your own by a simple trade. Using the world currency option from the Forex again, how would you execute that? You can create a synthetic cross-rate option. You're going to buy one and sell the other, and we're going to show you how to do that, and you'd be able to get the benefits of the underlying movement of that cross-rate while eliminating the impact of the dollar in the trade. You would buy a call and buy a put in the different currency pairs. In the example, you would buy an XDE call and buy an XDB put in ratio. So you got to make sure you keep the ratio straight. You could put yourself into problems. But in this trade, the U.S. dollar would cancel out. Now, what I mean by ratio is you do have to figure out what's the dollar value for each, and you may need to buy, I'm going to just make up an example. You may need, in this example, and don't go trade this, it's just an example for teaching, you may need to buy, for example, 2 calls and 3 puts to have ultimately the same amount of dollars at risk and ultimately U.S. dollars crossed out of the trade. Here's an example. The euro pound cross, we would take the euro U.S. dollar at 157. Again, this is an older example, but it still works. And the pound dollar at 198. We would divide them, and we come up with a ratio of about 0.7929 is the relationship between those 2 pairs. So you would take 0.79 pound to every 1 euro traded. So that's your cross rate. You did it with the Australian Canadian, you have 87 and 94. You do the same thing again, divide the 2 to come up with your ratio. And so you can take 0.922 Canadian dollars to buy 1 Australian dollar. And before, I know there's some of you out there thinking, man, I can do this cross rate, and then I can do the cash, and I can arbitrage. Arbitrage is a classroom term that rarely applies in the real world. Trust me, the reason that these relationships work is that all of the currency markets in this example, whether it be futures, spot, or options, are all driven by arbitrage, so that there would be no advantage present to you and I. Now, there may be at the big brokerage firms and the big trading companies may be able to exploit temporary minute differences in these rates, but for our example, let's just assume that there is no ability to go out and arbitrage, although it would be nice. So the world currency ratio example, if you had 10,000 euros at 1.57 and 10,000 Aussie at 0.96, you would establish the ratio with approximately the same amount of U.S. dollars. So in this example, you'd buy 6 XDE 157 calls, and you'd buy 10 XDE 96 puts. So you're long approximately $94,200 of euros and short approximately $96,000 of Australian dollars. So you now have the ratio that you want. Now let's be clear, you do end up with 2 transactions to get in, there probably is, that's a consideration when doing these trades. But it is a way to capitalize on these using options rather than going straight to the spot market. Here we have another example, 10,000 Australian, 87, 10,000 Canadian, 94. We established the ratio with the approximately same number of US dollars by 22 XDE, by 20 XDC of the 94 puts. You're now long approximately 191,000 Australian dollars, dollars of Australian dollars, and then your risk is you're short about 188 of Canadian. So again, you build the ratio, you can have this happen for you. You can make these cross trades, and there is money to be made doing it. I like the trades. It can present a great opportunity, and it's a market that a lot of people don't know about. Not many people trade this way, and you can set yourself apart and find some opportunities. Why is the cross trade an advantage? It's similar to the options advantage. Directional with the built-in risk management tool, and I can't emphasize that enough. It's the key to options. Is you have built-in, when done properly, when you buy options. Again, selling options puts you in a position where your risk management may be going out the window, and I almost never would recommend you doing that. But taking the ability to build your risk around a directional play with the safety of the OCC and a listed exchange is a big advantage. It can be a volatility trade. We touched on volatility slightly here, but you may be able to build a volatility trade where the underlying volatility in one of the pairs might exceed the other, and it might be something that you can capitalize on. And the cost can be significantly lower. We showed that at $100 for a $1 contract, the ability to get in with a smaller portfolio with a smaller capital at risk and work towards building your account, it makes a big difference. I am running out of time. We've got a great day today. I'm, again, privileged to be the leadoff hitter. We've got some really good speakers coming in behind me for the rest of the afternoon. You've got a lot to learn. I hope everybody's got a couple extra pens because you might run out of stuff to write. For me, I'll type in my email address here. As always, if you have any questions, if you need the slides, you have a question about trading this or anything else we've talked about, I just threw it up there, gregm@ctutrading.com. We're very excited to have all of you here today. We know it takes taking time out of your day is important, and we recognize and value your time. So we're going to keep these presentations moving, each bringing you a different look at the market, a different way that you might be able to improve as a trader. Fausto touched on it earlier. He was sitting in a trading down at the money show, and he's learned something. I sit in these things and I learn all the time. I'm nowhere near the point where I would say I know everything. I'm clearly not there. And it's you find something that somebody says that kind of hits home with you. Find somebody who trades with a style that you have. And the last thought I'm going to tell you, last thought I'm going to leave you with as I hand the ball over to Fausto and the team is that, as mentioned earlier, this is not a get-rich-quick scheme. This is a job. There's lots to learn, and you continue to learn. And we're not going to teach you that there's a magic way that you can retire tomorrow. If there were, we would have all done that. It's about building your educational base, learning from our mistakes. And that's one of the big advantages Fausto alluded to, is when you're learning from people who have traded on the floor, I can tell you, every single person on this call, that I've taken more losses and made more trading mistakes than any of you. And I've paid for that education in time and effort and money over the last 20 years. And I think the advantage you have with dealing with people who have traded on the floor is you take the faster path. And if you can take that faster path, it's an advantage to you and becoming a successful, profitable trader. Anybody who's asked, all I need you to do is send me an email, and I'd be happy to send you the PowerPoints. I think now we're going to get ready for our next presentation. I see they've loaded up. Chris is getting ready to go.